In his thought-provoking book, Fault Lines, Raghuram Rajan, former chief economist at the International Monetary Fund, provides a nuanced and insightful analysis of the complex forces that led to the global financial crisis of 2008 and continue to threaten the world economy. Rajan argues that the crisis was not simply the result of irresponsible bankers or lax regulators, but rather the consequence of deep fault lines in the global economic system. These fault lines, he contends, stem from domestic political stresses, trade imbalances between countries, and the clash of different financial systems. By examining these underlying causes, Rajan offers valuable insights into the challenges we face and proposes potential solutions to create a more stable and equitable global economy. One of the primary fault lines Rajan identifies is the growing income inequality in the United States. As wages stagnated for many Americans due to factors such as skill-biased technological change and globalization, politicians faced increasing pressure to address the concerns of those left behind. Rather than tackling the root causes of inequality, such as deficiencies in the education system, the political response was to expand lending to households, especially low-income ones. This push for easy credit led to a boom in subprime lending and a deterioration in underwriting standards, eventually resulting in a housing bubble that burst, triggering a wave of defaults and foreclosures. While the private sector bears significant responsibility for the crisis, Rajan argues that the government's well-intentioned but misguided policies played a crucial role in fueling the unsustainable credit expansion. Another major fault line Rajan identifies is the global trade imbalances that have emerged as a result of the export-led growth strategies pursued by many countries, particularly in Asia. Countries like Germany and Japan adopted a model of managed capitalism, in which the government intervened heavily to support the growth of competitive export industries. As these economies matured, they faced the challenge of transitioning to a more balanced growth model, but instead became increasingly dependent on foreign demand to sustain their growth. This led to the accumulation of large trade surpluses and the recycling of these surpluses into the global financial system, particularly into the United States. Other developing countries, such as China, followed a similar path, creating a global savings glut that put downward pressure on interest rates and fueled credit booms in deficit countries. Rajan argues that this pattern of imbalances is unsustainable in the long run, as it creates vulnerabilities and dependencies on both sides. A third fault line Rajan highlights is the potential for instability that arises when arm's-length financial systems, prevalent in the United States and the United Kingdom, interact with the more opaque, relationship-based systems found in many developing countries and parts of Europe. When arm's-length investors lend to borrowers in relationship-based systems, they may underestimate the risks involved due to a lack of transparency and a misunderstanding of the implicit guarantees and political factors at play. This can lead to an overextension of credit and the build-up of hidden risks, as exemplified by the Asian financial crisis of the late 1990s. To mitigate these risks, Rajan argues for greater international cooperation and coordination in financial regulation and supervision. Rajan also delves into the phenomenon of jobless recoveries in the United States, which he attributes to factors such as the changing nature of the economy, the increasing pressure on companies to cut costs, and the country's relatively weak social safety net. He argues that the Federal Reserve's monetary policy decisions in the early 2000s, particularly keeping interest rates too low for too long and signaling that it would intervene to prop up asset prices, contributed to the housing bubble and the subsequent financial crisis. These actions created a powerful incentive for financial institutions to take on leverage and invest in risky assets, leading to a self-reinforcing cycle of credit expansion and asset price inflation. Furthermore, Rajan examines the underlying incentives and structures within the financial system that contributed to the build-up of risk, such as the way in which financial sector compensation is structured, and the increasing complexity and opacity of modern financial products and transactions. He suggests that addressing these distortions will require a fundamental rethinking of the incentives and structures within the financial system, including reforms to compensation practices, greater transparency and standardization of financial products, and a greater emphasis on risk management and responsible behavior. Building on his analysis of the fault lines that contributed to the financial crisis, Rajan offers a range of proposals for reforming the financial system to make it more stable, transparent, and responsive to the needs of the real economy. He argues that these reforms should be guided by a set of broad principles, including the need to promote competition and innovation, reduce incentive and price distortions, and make the system more resilient to shocks. One key area of focus, according to Rajan, should be on reducing the problem of too-big-to-fail institutions that are deemed systemically important and thus enjoy an implicit government guarantee. These institutions, he argues, have an incentive to take on excessive risk, knowing that they will be bailed out if things go wrong. To address this problem, Rajan suggests a range of measures, such as requiring systemically important firms to hold more capital and liquid assets, subjecting them to more intensive supervision and stress testing, and creating a credible resolution mechanism to allow them to fail without causing broader damage to the system. Another important area of reform, in Rajan's view, is to address the distorted incentives within the financial industry that encourage excessive risk-taking and short-termism. This could involve measures such as requiring a larger portion of bonuses to be deferred or tied to long-term performance, as well as greater transparency and accountability around compensation practices. It may also require a greater emphasis on risk management and stress testing within financial institutions, as well as stronger oversight and regulation by authorities to ensure that firms are not taking on excessive risk. Rajan also stresses the importance of promoting greater competition and diversity within the financial system in order to reduce the concentration of risk and the potential for systemic instability. This could involve measures such as encouraging the growth of smaller and more specialized firms, as well as promoting the development of alternative financing channels, such as peer-to-peer lending and equity crowdfunding. It may also require a re-examination of the role of government-sponsored enterprises, such as Fannie Mae and Freddie Mac, in the housing finance system, and a greater emphasis on promoting private sector solutions. Another key area of reform, highlighted by Rajan, is the need for greater transparency and standardization in financial markets. He argues that the complexity and opacity of many financial products and transactions can create a false sense of security and make it difficult for investors and regulators to understand and monitor risks. To address this problem, he suggests measures such as requiring greater disclosure of information on financial products and exposures, as well as promoting the development of standardized contracts and reporting formats. This could help to reduce the potential for contagion and systemic risk by making it easier for market participants to assess and price risk accurately. Rajan also emphasizes the importance of international coordination and cooperation in financial regulation and supervision. Given the global nature of financial markets and the potential for cross-border spillovers, he argues that it is essential for regulators and policymakers to work together to develop common standards and approaches. This could involve measures such as harmonizing accounting and disclosure requirements, sharing information and best practices, and coordinating responses to emerging risks and challenges. In addition to his proposals for reforming the financial system, Rajan stresses the importance of addressing the underlying economic and social fault lines, particularly the problem of rising inequality and declining opportunity in the United States. He argues for policies aimed at promoting greater access to education and training, strengthening the social safety net, and promoting greater economic security for workers. This could involve measures such as increasing funding for early childhood education, improving the quality and affordability of higher education, and expanding apprenticeship and vocational training programs. It may also require a greater emphasis on lifelong learning and retraining to help workers adapt to changing job requirements and technologies over the course of their careers. Another key factor driving inequality, in Rajan's view, is the decline of institutions and policies that have historically helped to promote shared prosperity and opportunity, such as unions, progressive taxation, and a robust social safety net. He argues that these institutions have been weakened by a combination of economic, political, and social forces, including globalization, deregulation, and changing cultural attitudes. To address this problem, Rajan suggests a range of policies aimed at strengthening the social safety net and promoting greater economic security for workers, such as expanding access to healthcare and retirement benefits, reforming the unemployment insurance system to provide more generous and longer-lasting benefits, and increasing investments in affordable housing and other public goods. Finally, Rajan emphasizes the importance of global cooperation and coordination in addressing the fault lines that threaten the stability and sustainability of the international economic system. He argues that the challenges we face, from trade imbalances and financial instability to inequality and climate change, are inherently global in nature and require a coordinated response from the international community. One key area where global cooperation is essential, according to Rajan, is in addressing the problem of global trade imbalances and the risk of protectionism and economic nationalism. He notes that the current system, in which some countries rely heavily on exports while others run persistent trade deficits, is unsustainable in the long run and creates vulnerabilities for both sides. To address this problem, he suggests a range of measures, such as promoting greater exchange rate flexibility, encouraging surplus countries to stimulate domestic demand, and investing in infrastructure and other public goods to boost global growth. Another key area where global cooperation is needed, in Rajan's view, is in promoting greater financial stability and resilience. Given the interconnected nature of global financial markets, he argues that it is essential for regulators and policymakers to work together to develop common standards and approaches, share information and best practices, and coordinate responses to emerging risks and challenges. This could involve measures such as harmonizing accounting and disclosure requirements, strengthening cross-border resolution mechanisms, and promoting greater transparency and standardization in financial markets. Rajan also stresses the importance of global cooperation in addressing the problem of climate change and promoting sustainable development. He notes that the costs and benefits of climate action are inherently global in nature, and that no single country can solve the problem on its own. To address this challenge, he suggests a range of measures, such as promoting greater investment in clean energy and infrastructure, putting a price on carbon emissions, and providing support for developing countries to transition to a low-carbon economy. Ultimately, Rajan argues that promoting global cooperation and coordination will require a fundamental shift in the way we think about our shared interests and responsibilities as a global community. This means recognizing that the challenges we face transcend national borders and require a collective response based on mutual understanding, trust, and respect. It means moving beyond narrow notions of national self-interest and embracing a more expansive vision of global cooperation and solidarity. To achieve this vision, Rajan suggests that we need to strengthen and reform the institutions and frameworks that facilitate global cooperation, such as the United Nations, the International Monetary Fund, and the World Trade Organization, while also building new forms of global cooperation and partnership that bring together governments, civil society, and the private sector to address shared challenges and opportunities. At the heart of Rajan's argument in Fault Lines is the idea that the challenges we face are inherently interconnected and require a holistic and integrated response. From rising inequality and declining opportunity to global trade imbalances and financial instability, he shows how these problems are rooted in deeper structural and systemic issues that cannot be addressed in isolation. Instead, he argues for a comprehensive and multifaceted approach that combines policy reforms, institutional changes, and a fundamental shift in our cultural and societal values. Central to this approach is the need to promote greater access and opportunity for all, particularly those who have been left behind by the forces of globalization and technological change. This means investing in education and training, strengthening the social safety net, and creating a more inclusive and equitable economy that benefits everyone. It also means recognizing the importance of global cooperation and coordination in addressing shared challenges and opportunities, and working together to build a more stable, sustainable, and prosperous future for all. Ultimately, Fault Lines is a powerful and thought-provoking book that challenges us to rethink our assumptions about the way the world works and our role in shaping its future. By laying bare the deep-seated fault lines that threaten our economic and social fabric, Rajan provides a roadmap for navigating the challenges ahead and building a more resilient and inclusive global community. His insights and recommendations are essential reading for anyone seeking to understand the root causes of the global financial crisis and the steps needed to create a more stable, sustainable, and prosperous future for all.